So now let's take a look at the Trix, also known as the triple exponential indicator. The Trix is another type of oscillator which uses the stock's exponential moving average. The Trix momentum indicator shows the percentage rate of change of a triple exponentially smooth moving average of the stock's closing price. The Trix can be used in several ways, but is mainly used for trend analysis. It's plotted on a scale where the indicator will oscillate around a zero line. Unlike other oscillators, the Trix's triple exponential smoothing removes the cycles that are shorter in length than the periods that you selected. It's calculated using 3 exponential moving averages over a selected period of time. Each exponential moving average is used to smooth out each previous moving average, and the percentage of the difference between today and the previous day's value in the resulting smooth series is calculated. The smoothing of the price data allows us to analyze and follow a stock's trend. The triple smooth EMA has a weighted spread which is more broader than a normal EMA. With a normal EMA, the latest few days are weighted more than the past few days, which tends to follow stock prices more closely. With the triple smooth EMA, the most recent trading days are actually weighted less than days further back. If the Trix line slope is rising and positive, this is considered to be an uptrend signal. If the Trix slope is negative and declining, this is a downtrend signal. In order to find good entry and exit points using the Trix, you can implement a crossover strategy using the signal line. When the Trix crosses above the signal line, this will be the time to look for a good entry point. If the Trix crosses below the signal line, this indicates a downturn is likely, and you can either look to sell or to go short. You could also use the center zero line to analyze trend directions and changes. When the Trix crosses above or below the zero, this may be a signal that the trend is changing. You could also look for divergences between the Trix indicator and the stock price movement to help predict trend reversals. For example, if you notice the Trix begins to trend down on the scale, but the price movement has not yet followed, this could indicate a downturn is potentially coming. So now let's go over how to apply and use the Trix indicator on our candlestick chart. To add the Trix to your chart on TradingView, let's click the indicator icon and search for Trix. Instead of selecting the built-in Trix indicator on TradingView, we're actually going to select the Trix MA from the public library. This indicator will have both the Trix and its moving average in order to implement the crossover strategy for trading. So here's the Trix and its moving average down here at the bottom of our candlestick chart. Similar to other oscillators and indicators, it can be used in multiple ways for stock trading. First, let's take a look at the zero line strategy. The Trix indicator is plotted on a scale that fluctuates above and below the zero center line. If the Trix indicator is above the zero center line, the stock is likely in an uptrend. If it's below the zero center line, the stock is likely in a downtrend. You can use the Trix going above or below the zero center line as a signal for a trend reversal. If the stock is in a strong uptrend, it will likely bounce off the center line instead of breaking below it. But once the Trix does break below the center line, a stock reversal is likely coming. This would be the time to start using other indicators to look for an exit or to go short. In order to re-enter the stock, you want to wait for the Trix to go back above the zero line. This is a signal that the bear market is likely over and an uptrend is starting. Another way you can use the Trix to predict trend reversals is to look for divergences. For example, if you look here, you can see that the Trix indicator pretty much follows the stock price movement. But as the stock price continued to make new highs here, the Trix indicator began to fall. This is called a bearish divergence, and a trend reversal will likely follow. You can see that after the divergence occurred, the stock price quickly fell to get back in sync with the Trix. So now let's take a look at the Trix crossover strategy, which is probably my favorite out of the three. If we take a look at the Trix on our chart, we can see that there are two lines on the indicator. One is the Trix itself, and the other is the signal line, which is its moving average. When the Trix crosses above its signal line, this is a buy signal. When the Trix crosses below the signal line, this is the time to sell. Using the crossover method, you'll receive many more buy and sell signals than with other strategies. This is great for short-term technical trading. During an uptrend, the Trix will bounce off the signal line multiple times, almost acting as a support. But once the Trix crosses below the signal line, this is the time to start looking for your exit. The signal line will now act as a resistance level for the Trix. But once the Trix breaks through and crosses back above the signal line, this is the time to start looking to get back into the stock. So that's a few methods for using the Trix indicator for stock trading. Some strategies with the Trix are pretty accurate, but you still want to combine it with other indicators to confirm any signals. I'll see you in the next video.